everyone, it's Richard, watching The Plain Bagel. In the latest example of how tariff news is driving stock market performance, this past week we saw one of the strongest single-day rallies of the S&P 500 in recent history, with the index closing nearly 10% higher this past Wednesday on the news from the Trump administration that they would be enacting a 90-day pause on the wild tariffs announced the previous week and switching to a 10% flat tariff rate for all but one country.
China.
In fact, in their case, Donald Trump actually escalated things by slapping the country with a 125% levy in light of their recent retaliation, a move that was later reciprocated by China. And with these two Goliaths representing over 40% of global GDP, and the World Trade Organization warning that a decoupling of these two economies could have a 7% impact on global GDP, markets were naturally still pretty nervous that Donald Trump was seemingly doubling down on his trade war with the country. So it came as quite the surprise when late Friday, the US Customs and Border Patrol published a notice highlighting that smartphones, computers, and other electronic devices and components would no longer be subject to tariffs, including the 125% tariff against China, which is notable given that electronics represent over a fifth of their exports to the United States, and China is the primary source of imported smartphones, lithium batteries, and other key electrical components into the United States. A pretty surprise pivot given the recent escalation and the fact that we haven't seen any announcements of any sort of progression with negotiation between the two. So, why the pivot? Well, we don't know at this point. It could be that Donald Trump is extending an olive branch with this, or it could be that he's due for a mobile upgrade and didn't want to pay $3,000 for a made in USA iPhone. But there are some interesting speculations that all this has to do with the US Treasury bond market. You see, through this past week, during this tit-for-tat trade war escalation, we saw a peculiar trend within US Treasuries, whereby the rates saw their highest weekly increase in decades. Something that Donald Trump has acknowledged and that some believe is behind his walking back of some of these policies, with some even claiming that China or some other trade partners are actually behind this and somehow masterminding the situation to force Trump to reverse some of his tariffs. So given the rampant speculating around what's actually going on here, the concerns and ringing of alarms over the rising Treasury yields and the impact it could have on the US financial system, and just generally the importance of a trade war between these two global Goliaths, I figured I would try to explain the situation, describe what we know to date, what people are speculating, and put it all into perspective. And to be clear, this is a very fast developing story. By the time I post this, we could see a complete reversal, or maybe we start seeing quadruple digits on tariffs, because at this point, why not? But as of the time of posting, this will be everything we have up to date. So let's get up to speed with a very brief timeline of how the US-Chinese trade war has so far played out in 2025. As most people are aware, China was one of the first countries alongside Canada and Mexico who were first slapped with tariffs under Trump's second term, with Trump first enacting a 10% blanket tariff on February 4th, then increasing this to 20% on March 4th, and then later on the so-called Liberation Day or April 2nd, adding an additional 34% tariff against China, bringing the total amount to 54%. Now up to this point, China had primarily retaliated by imposing select tariffs, initiating investigations into certain US companies, and even adding a number of businesses to their unreliable entity list that would impact their operations. But on April 4th, in addition to limiting the export of certain rare earths and expanding the country's unreliable entity list, we saw the country retaliate by copying Trump's latest hike and announcing a 34% tariff of their own on US imports. And from there, it was off to the races. The US hiked tariffs on Chinese goods by 50 percentage points on April 8th. China announced their own 50% hike on April 9th. Trump pushes further to 125% while announcing the pause on other punitive tariffs for other trading partners. The US then clarifies that this is in addition to the original 20% tariff, bringing the total to 145%. And then finally, just on Friday, China brought their own tariff to 125%, which are the final rates we're at now as of the time of posting. Now, as for why Trump has seemingly singled out China here while giving most other countries a break, it appears to be the country's massive trade imbalance with the United States. China by far represents the largest of America's trade deficits at nearly $300 billion for 2024, or just shy of a third of the country's total trade deficit, with the US importing 3 times more from China than it exports to the country. And that's just based on the official figures. In reality, the gap is likely larger due to a tariff loophole for what are called de minimis merchandise, or goods that are under $800 of value, which are allowed to be brought into the country duty-free, something that's contributed to the popularity of sites like Shein and Temu, but that with this trade war is set to be closed in early May. So with Trump being very vocal and lambasting the US's trade imbalance, it sort of makes sense why China has been targeted here. But this actually stretches back to Trump's first term when he first imposed tariffs on select Chinese goods, with the US accusing the country of using, quote, state-led market distorting policies and practices that ultimately disadvantaged many of the country's trade partners and has led to the country being a massive net exporter. Which generally speaking is fairly true. China is very controlling not only of its own economy and companies, but also which foreign companies can ultimately gain access to its market. And while the initial escalation ultimately ended with the signing of the Phase 1 agreement in 2020, whereby China committed to buying more US goods, giving more market access to its economy, and addressing structural concerns the US had about its markets, such as around IP protection. To date, the agreement has been considered somewhat a failure, with China ultimately buying just 58% of US exports it initially committed to. And since then, while Chinese imports have actually decreased, the trade gap is still pretty meaningful, which helps to explain some of the motivations here, with the US also generally having this view that they have a lot less to lose from a trade war than China here. After all, exports represent just 11% of US GDP, with China just being the third largest destination of those goods, and exports for China representing 20% of the country's GDP, where the US is the largest destination of those goods at 15% of total exports. But while it might be true that China will hurt more from this trade war, to be clear, it will still have a meaningful impact on the US economy if it persists. China still represents roughly 7.1% of total US exports, meaning that the industries that the country buys from will still see an impact, with China buying 14% of all US agricultural exports, and they're also a key buyer of other key categories like livestock, oil, semiconductors, and pharmaceuticals. And while it's difficult to come to an overarching GDP or inflation impact figure, given how volatile the situation has been, naturally, any inbound product from China is also going to become more expensive in the United States, with the key import categories being electronics, machinery and appliances, textiles, and metals. In fact, the vast majority of cell phone and game console imports, 70 and 90% respectively, enter the United States from China, with a number of analysts highlighting how expensive iPhones, for example, would be under the tariffs before the recently announced exemptions. High-tech manufacturing like military equipment and electric vehicles is also likely to be impacted, with China being a key refiner of nickel, lithium, cobalt, and the vast majority of rare earths. So when looking at the high level of this trade war, the impact is expected to be pretty meaningful, with the Budget Lab AL estimating that even with the 90-day pause on reciprocal tariffs for other trading partners, the escalation with China would still bring the US effective tariff rate to over 27%, push prices nearly 3% higher, costing the average household $4,700 a year, and decrease US GDP by more than a full percentage point. So you can see why many are pretty nervous about the US-China trade war. But if Twitter posts are to be taken at face value here, the reason we've seen this reversal on tariff policy is because China has a secret weapon here, a way to hit Trump where it hurts. Treasury yields. You see, one of Trump's stated objectives has been to lower interest rates in the US economy, and Treasury yields, which are simply the interest rate paid by government debt divided by their price, are used as a benchmark for many other debts in the economy. So as we see Treasury yields decrease, we also generally see the cost of other debt decrease, like mortgages, car loans, and the like, which can boost economic activity as interest rates are lower and more people are willing to borrow money and spend. And historically, because Treasury bonds are considered a safe haven investment, meaning that they're deemed to be very low risk and an attractive investment during times of uncertainty, we've often seen investors sell stocks and buy Treasury bonds during periods of turmoil, which leads to falling yields and falling interest rates, given that they're increasing the market price, which, based on the formula, lowers yield, acting as a sort of automatic stabilizer. However, amid all the tariff uncertainty, the exact opposite has actually happened, with us seeing a Treasury bond sell-off, with the 10-year Treasury yield seeing its highest weekly jump since 2001 and 30-year yield seeing its highest weekly jump since 1982, with both briefly surpassing 5% this past week before settling just under this level, which has led to some sounding the alarm over how this will impact the financial system in the United States, not just because debts are suddenly more expensive and that decreases demand, but because higher rates can affect existing leverage in the system, forcing traders and companies alike to rein in investing and spending, because higher yields decrease the value of fixed income assets that are held by financial institutions, meaning banks and the like see the assets backing their deposits fall in value when yields increase, which is actually an important factor that contributed to the collapse of Silicon Valley Bank back in 2023. With some, again, arguing that this is actually what led to President Trump delaying the tariffs on most other trading partners and announcing the recent electronics exemptions, with some going so far as to speculate that China is actually the one behind these rising yields. So what's going on here? Is China trying to sabotage the US financial system in retaliation? Well, maybe. It is true that China holds a bunch of US Treasury bonds and could potentially be offloading the amount, contributing to the sell-off. For example, as of January 2025, China held $760 billion worth of US Treasuries, making up 9% of all foreign-held US Treasuries. And there are rumors circulating that China recently sold $50 billion of these Treasuries, which would be a sizable 7% of their holdings. However, this does really appear to be a rumor, with the source of it being X. We do, however, have an article from Reuters claiming that the Chinese central bank is instructing state-owned banks to reduce their purchase of US dollars, money that would otherwise generally be parked in US Treasuries. But the truth is, no one knows with certainty what's actually contributing to the sell-off. It's mostly speculation at this point. And while yes, China does have a reason or cause to retaliate against the US, for one, the move around state-owned banks appears to more so be focused on preserving the yuan versus hiking US interest rates, since the yuan has fallen against the dollar to its lowest point since the financial crisis. Two, while China is a good chunk of foreign-held treasuries, that segment only represents roughly a quarter of total federal debt. So while $760 billion of treasuries is still a lot and could still move the market, it is still just 2.1% of total US debt. And three, China selling US Treasuries isn't actually anything new. In fact, at its peak in 2013, the country held $1.66 trillion of US Treasuries, representing 7.4% of total US debt, with the dollar amount now being less than half of that. And over the last 12 months alone, China reducing its Treasury holdings by 4.6%. So while China may have very well carried out a bulk sale of Treasuries to have this impact, just more information to try and put in perspective. There is also the chance that we've seen retaliatory selling from other countries, with Japan, the largest foreign holder of US Treasuries, being accused on X and even during a Fox Business News segment of doing just that.
Somebody asked them if it was China, right? It wasn't. It was Japan.
And some even sharing the wild speculation that Canada's Prime Minister, Mark Carney, somehow orchestrated all this by coordinating foreign selling of US Treasury bonds. But at this point, we really have no evidence of any of that. The sources of these claims haven't presented the proof of these speculations, and at least publicly, Japan's finance minister has even ruled out the use of US Treasuries for diplomacy purposes. And there are a lot of other potential causes of the sell-off. We could be seeing foreign countries selling Treasury bonds to put the money to other uses. There could be this expectation of less demand for Treasury bonds from foreign countries in the future because of expectations of less global trade. A lot of foreign Treasury bond demand has come from countries receiving US dollars as a result of trade with the country. So if these countries expect less US trade and therefore less US dollars, it could lead to less demand for US Treasuries. And finally, some have even highlighted that the sell-off is due to the higher perceived risk of US Treasuries, that investors for the first time in a while are not viewing Treasury bonds as being as much of a safe haven as it used to be. Something that's been highlighted by Deutsche Bank, which noted that US Treasuries have actually decoupled from other safe haven assets like gold during the recent turmoil. You see, the bond market likes government stability, and the last few weeks have been anything but. And with how unconventional and quick to pivot Trump has been to date, there is a chance that's weighing on bondholders and increasing the perceived risk around treasuries, especially given that with the US seemingly targeting all of its trade partners at once, it could hamstring its own economy with this isolationism. So all these things may be playing a role. We could be seeing foreign countries selling US treasuries. We could be seeing investors viewing treasuries as being higher risk, or it could just be the result of a technicality, like an over-leveraged trader somewhere being forced to unwind their US treasury position. We really don't have the information we need at this point to determine the cause. Nonetheless, it's an important factor to watch during a period of time where the country already faces a multilateral trade war. That all being said, the hope with all this, of course, is that the recently announced tariffs are temporary, which, strangely enough, given how high they've become recently, have almost given people more confidence that these tariffs will eventually be reversed, that they're so ridiculous that of course the countries will have to negotiate a better trade deal. After all, the US depends on China for low-cost goods and certain key resources, and China does depend on the US as a key export market and even for importing certain goods like advanced microchips. And given that the US has hurt its alliance with a lot of its trading partners, that could also lead to pressure for a deal to be reached. But with all of it, we unfortunately just have to wait and see to see what factors are ultimately contributing to rising yields, to see how the US, China, and all the other countries involved ultimately react to the current trade war. And here's hoping cooler heads prevail. Thank you guys for joining today. I hope you found this video helpful. If you did, please do make sure to like, subscribe, all that good stuff. It does help the channel tremendously. And let me know what other non-tariff topics you'd like me to cover. I swear I'm trying to move away from this stuff. But just when I think I'm out, they pull me back in. Anyway, yeah, thanks again for joining. And as always, be safe out there.